And, 16,000 tokens, I think, unfortunately, Josh, the vast majority of those are speculative Ponzi products that really have no utility for the world, and we need a clean out. And so for investors right now, it's incredibly difficult to choose your path. And so we're amidst a lot of noise, but I think this year is going to see some of that noise diminish. And I'm certainly expecting consolidation in the market, both at the infrastructure level in blockchain technology itself, but also in the volume of those tokens that are trading around the world.
Welcome to Seeking Alpha's CEO interviews, informed conversations with the best and brightest CEOs in the publicly traded markets. Quality of leadership is a decisive factor in stock performance. Our show provides intimate and in-depth investing discussions with industry leaders across all sectors of the marketplace. We publish excerpts on social media platforms and the full conversations on seekingalpha.com or on our highly rated Seeking Alpha mobile app under CEO interviews.
Welcome back to Seeking Alpha. I'm Josh Kincaid, capital markets analyst, and today interviewing CEOs. My guest today, Richard Baker, CEO of TAAL Distributed Information Technologies, available on the OTC under ticker symbol TAALF. They're a provider for enterprises that want to transact on blockchain. Richard, thanks for being with us at CEO interviews.
No problem, Josh. Thank you very much for having me.
So diving just right in, I want to talk a lot about blockchain, first about crypto, a lot happening in the markets, starting off with, let's start off with Jamie Dimon. 2017, he called Bitcoin a fraud. In October of 2021, he said Bitcoin was worthless. And then just 3 months later, in February of 2022, JP Morgan Chase announced that it would become a strategic investor in trading and lending, as well as tokenizing equities, fixed income, and other assets that may eventually serve as a bridge to DeFi protocols. On top of that, we have ousted WeWork founder Adam Neumann, who wants to put carbon credits on the blockchain with goddess nature tokens to combat climate change. Having said all of that, Richard, are we seeing cryptocurrencies and their valuations being a fad? Or is crypto the equivalent to an early investment in Amazon or somewhere in between?
Wow, great backdrop question, Josh. Yeah, I think we're actually coming into 2022, and particularly this quarter, we're at a bit of an inflection in the whole journey. I think, for your audience, I'm sure many know, but we're talking about a 13-year journey. The Bitcoin protocol was a white paper 13 years ago. We've seen blockchain in the first form of, the Bitcoin protocol really come to market in kind of 2015. And really, there's been a springboard, I think, from 2015 onwards, where we've got lots of different blockchain technologies. And now I think with that, we've got something in the order of 16,000 crypto tokens on the planet. So where are we? I think we've come through quite a learning curve. We've come through a hype cycle, if you like. I think sentiment at the moment is that we're beginning to see a consolidation in the market. Do really all of these blockchains offer a utility promise? Will they actually help financial markets transform, become more efficient, become more safer, bring transparency? Not all of them. Will they help enterprises? No, because many of them don't scale and their gas fees are exorbitantly high. You just can't run transactions for enterprises on many of those blockchains that exist. And, 16,000 tokens, I think, unfortunately, Josh, the vast majority of those are speculative Ponzi products that really have no utility for the world, and we need a clean out. And so for investors right now, it's incredibly difficult to choose your path. And so we're amidst a lot of noise, but I think this year is going to see some of that noise diminish. And I'm certainly expecting consolidation in the market, both at the infrastructure level in blockchain technology itself, but also in the volume of those tokens that are trading around the world. And we can comment on some of the last few weeks of activity on the not so stable coins, but I think we're about to see a real change in market structure.
Well, let's talk about one of them. I think that deserves some recognition. Some of those coins that are Ponzi's, I think maybe started off as like gift cards in a sense, and they just never took off. Obviously, Doge started off as a joke, and then everybody is in on the joke now.
Yeah, exactly.
But Terra USD. So there's a complete collapse of the Terra USD stablecoin and its support coin Luna in May. It sent shockwaves through Bitcoin and the crypto markets. It sparked fears in areas of crypto ecosystems. that they could also falter. There's been discussions, heated discussions around layer one blockchain that you might be able to go into. That's the base networks. After popular blockchain Terra collapsed earlier this month, they were the second largest blockchain for decentralized finance protocols in terms of total value locked, only behind Ethereum. Wondering if you care to explain what happened and how that could have been prevented.
I can't speculate on how it would be prevented. I think fundamentally, the ecosystem that I work in, and TAAL is a publicly quoted company on the Canadian stock market, but we're a company that has expertise in the Bitcoin protocol, Josh. And, I think we are proponents, supporters, and advocates of the Bitcoin protocol in its original native design. And, we will see time play out, but ultimately as a blockchain, Bitcoin is both a protocol and a network technology, and it is ultimately a technology that was designed and built to be a digital cash system, and it has utility value. And when I give you that logic of argument and I compare that then to what was really going on with Terra and Luna, it was trying to emulate, a retail and wholesale market structure and try and bring some confidence to the lens of a stablecoin to investors. But fundamentally, it was built as a pyramid system, and it required a number of components to be propped up in order for it to hold its value. And we've seen that collapse, and I don't think we're going to see that recover. And that I think has sent shockwaves through the financial markets, but it's also now shaken at the core the volume of these speculative coins that are in the market. And I'm going to use this language a little bit, which is we've got to just accept that there's a large volume of those coins that are in the market that are speculative and only speculative. Even BTC as a product is a speculative product, but it's been heralded as a store of value product. And today it's been held as a store of value product because it's got a lot of institutional investors propping it up. But its store of value has actually got no long-term utility value. And so when I talk about the disruption that we have in the market now and a consolidation phase, but ultimately a growing up, I think we've got to start to be robust in our questions about these blockchains and these coins. If we're really expecting the future of finance to be tokenized and securities to become tokenized and efficiencies of financial markets to start to lean on blockchain technology, then that technology is underpinning fundamentally utility value. And I don't think enough robust questions are asked like that.
So in your opinion, is the only difference between some of these pyramid schemes and Bitcoin is a court of public opinion? Is the store of value simply just in the eye of the beholder?
It is presently, absolutely, it is. And, I think this is part of an evolutionary phase of the market, of course, but when you and I begin to think about the transition of retail and wholesale financial markets over the next 5, 10, 15, 20 years, it's commonly known now that many exchanges in the world are beginning to think about shares becoming tokens, and the issuance of shares in publicly quoted companies, I expect in the next 5 to 15 years, will be fully digital. We're seeing many of them be hybrid right now. We've now got over 100 countries in the world, Josh, announcing and deploying digital central bank digital currency strategies. And so we're beginning to see blockchains fundamentally come in as a core component of a treasury strategy to think about the future of money in traditional banking systems, in retail banking systems. And so we have hit an inflection point in the last 12, 18 months where blockchain is accepted as a technology of the future. It is understood fundamentally to be a fabric of Web3 and the next generation of peer-to-peer cash systems. And this is where the utility value is. It's not in speculative ICOs and coins that fundamentally have no grounding. Mm-hmm. Sorry, my passion for this comes out a little bit, but I think we've got to accept that this inflection is really, really required because it can't continue in the current form that it is.
You set up my next question perfectly when you had talked about the 16 and 19,000 coins that are out there that a lot of them can't scale and they're not worth anything because they don't have utility. leading me to my next question about Solana's blockchain. They had to restart after a bug caused a 4.5-hour outage. Can you use it if it's not working? And I know there's always issues with technology, but what I'm curious about is what happens to data when banks liquidate blockchain companies, like what we saw in the Irish-based independent.e, or when there's power outages and all of a sudden you don't have the transactions available. What happens to that data?
Yeah, I mean, great question. And the answer is no. I mean, a blockchain, firstly, the design principles of a blockchain, it is ultimately a public, transparent digital ledger. And it needs to be permanently on. It's a 24/7, 365 network. It needs to be permanently available. It needs to be highly scalable, and it needs to come with security built in, and it needs to be supporting incredibly low transaction fees. And I think these are some of the attributes of a blockchain that can underpin the transformation of financial services and retail services and merchant services for the next generation economy. And so right now we've got, the foundations of proof of stake, which is the Ethereum network. And we've seen proof of stake fundamentally through the lens of Ethereum be very innovative. I can see the innovation through smart contracts, but fundamentally it can't scale, and its gas fees, its cost per transaction are prohibitively high. You and I are not going to go and buy a cup of coffee with a sub micropayment of an Ethereum token and spend $3 when it costs $16 to $17 to process the transaction at the back end. That's just not going to scale. That's not a utility service. So the Solana network, the Polkadot network, the Cardano network are all what are referred to as sidechains, layer 2 networks that have been invented to ultimately try and address the scalability challenge. But inherent, I think we've now seen, unfortunately, with the Axie Infinity outage and the leakage and theft, and now with Solidity itself or Solana, we've seen fundamentally that sidechains are not a scalable solution, and they also come with an inherent security flaw. The middleware of how you create that sidechain is opening up a potential security point as well in the network. So I think there's innovation on those networks that I don't want to ignore. They have heralded a new era of token concepts and smart contract tokens, but ultimately they need to come back to a protocol and to a network type that can scale and help them grow. And that, to my mind, is the original Bitcoin protocol.
For utility, the whole aspect, if it can't scale, it needs to have utility. Can you maybe explain briefly chain reorganization in terms of blockchain technology and what the impacts are? Because if they're getting rid of data, and then it no longer is, you can't utilize it any longer, where is that data? Is it just stored somewhere and you have to go to a microfiche at a library and pick that info up?
Well, I think ultimately, if you've got a network halting, then fundamentally that data doesn't exist at all, Josh. The transactions won't have been recorded. And so you've got hours of outage, you've got hours of lost transactions, and therefore those records are not kept. And that fundamentally introduces a flaw in, we've now lost a cascade of chain of events. And the whole premise of a blockchain ultimately is that you are looking at a chain. Chain logic is that you're able to rely on the trust of those chained events that allows you to believe in that ledger and allows you to believe in the security of that ledger. And so that, we've got a fundamental flaw here that I think, could any enterprise really be building on those networks? Could you put your banking system, your clearinghouse, your trade settlement, your margining rules? I wouldn't. That's not a place I would put my core business as a banking system. Mm-hmm. So I think when I say there's an awakening, I think we've had a lot of experimentation around NFTs and the invention of new concepts through tokenization. But really, when we're talking about the outright transformation of traditional financial markets, these layer 2 networks are not the solution for that.
So CrossFi or cross finance, that's combining that traditional finance instrument with blockchain to enable people to use crypto as if it were fiat. You're looking at like Reno, for example, they're trusting blockchain for their building records. New York City might store birth certificates and property deeds and other government documents. Russia's industrial giant Rostec, they announced a blockchain-based alternative to SWIFT's international dominance on the financial settlements. How are you seeing financial institutions trying to implement this? Because if there is a difficulty for utilization and scale and gas fees, how do you see crypto and blockchain changing traditional payments in fintech?
Yeah, so I think I had the honor and the privilege of being in Madrid a couple of weeks ago, and it was the International Swaps and Derivatives Association AGM. So ISDA is the main contracting format for, over $1 quadrillion worth of instruments in every asset class around the world. If you're trading a contract for difference or any kind of forward swap or futures contract, it conforms to ISDA rules. And I was really delighted, Josh, in that conference to see legal representation of all of the major banks of the world, all of the clearinghouses of the world, the SEC, CFTC, the regulators from Europe, the Financial Stability Board, everybody in that conference over 3 days. Every other panel was talking about blockchain, and whether it was talking about it through, the securitization using tokens for instruments in markets, whether it was talking about the cost savings that can be achieved in back end of clearing and settlement being augmented onto blockchain and improving transparency, potentially having a consolidated trade tape for the market so that all activities can be overseen by regulators. But I think when you look now at what the SEC is doing, the CFTC doing in Europe through ESMA with MiFID II rules, we're seeing G20 regulation pay attention to blockchain is my key point. And that means that we are going to see traditional roles and responsibilities of, am I a trading venue? Am I an OTC broker? Am I a clearinghouse? And if I'm dealing with any form of tokenization, it's going to be started to look through the lens of existing rules. And is it a security? Is it a commodity? And I think this is a really important step. And we've got a lot of policies sitting at the desktops of a lot of regulators and standards bodies now, looking at both the crypto industry and bringing that in line with regulation, but also actually embracing blockchain and embracing this technology to help existing industry transform. And again, we're early days on this, but for a conference like that to be so intimately studying the opportunity that this technology represents, I think gives you a very strong signal on where we're going. And so I guess my answer there to you is, the reality is I think every part of the retail wholesale financial system is going to be touched by a blockchain over the next few years. The opportunity is too big to miss now.
They definitely have FOMO. You have Bank of America's CEO saying they have hundreds of blockchain patents, but regulators won't allow them to engage in crypto. So they're trying to figure out how to play in that space. So I'm going to ask you a follow-up to that. But as banks are trying to get in, it seems like everyone else is trying to reallocate their human capital because they hired too many people. Layoffs spreading across blockchain industry as the bear market cycle impacts crypto firms. You have Gemini co-founders, the Winklevoss brothers, announcing that the company would lay off 10% of its employees. And on the same day, Middle East's largest digital currency exchange, Rain Financial, revealed it had to lay off dozens of employees as well. Having said that, what do you think about layoffs spreading across the crypto industry? Is that a good sign, or are we in a crypto winter and we should just buckle down?
I think, well, it's probably a dual answer here, unfortunately. So let's look at a lot of the layoffs you refer to there are coming through the lens of the BTC Bitcoin market. And so the crypto winter, we've got a lot of market participants that have exposure to BTC on the balance sheet that have grown fundamentally their mining operations, their hashing power to ultimately keep competing in the BTC network. So with so much presence, I think this year, Josh, is something in the order of $5.4 billion of new mining equipment coming into North America alone to continue to mine on the BTC network. And of course, that capacity is coming in because we've got another big halving event on the Bitcoin protocol in roughly May 2024. And so today, some of those layoffs are coming in from the fact that we've seen revenue of mining, which is derived really from subsidy fees from, winning the next block in the BTC ecosystem, those fees are being diminished right now with the low coin price. And, the network was originally designed to be much more than subsidy income. It was supposed to be ultimately a journey board where the miner earned subsidy to start with, but would move towards transaction fees from the network being a useful utility. And I'm starting here because we've got a lot of marketplaces, trading venues, OTC desks, custody banking services that have built up around the liquidity that was being generated from such a high volume of mining of subsidy on BTC. But that is about to shrink, and we're going to see one, consolidation in the market, but we're also going to see with that halving event whether really BTC will continue at such its heady heights and be that store of value and be that product that ultimately justifies all of that volume of participants in the market. And I think some of the layoffs are recognizing potentially that there is too much softness in that strategy, and it's probably not a place to be overexposed to. So this plays again to my point about, is there real utility value? Because if there was, it would be springboarding the next phase of liquidity, and it's not.
All right, Richard, I want to go back to a point you made earlier about adaptation with banks, and they're going to need to first figure out, what is it? Is it a security? Is it private property? Essentially this, what is it? You have Japan passing a stablecoin law that gave protection to crypto investors and essentially defined stablecoins as a digital currency, with issuance being restricted to banks, trust companies, and certain licensed companies that have money transfer agent agreements. In the US, the Bitcoin and crypto bill claimed to be fully integrated digital assets into the financial system is expected to define whether different cryptocurrencies are either securities or commodities. So how is cryptocurrencies ultimately going to be governed? Is it going to be a security, a currency, or private property, Richard?
I think, well, again, I refer to my visit to Madrid a few weeks ago, Josh, and listening to Gary Gensler of the SEC talking about this openly, and he is strongly a proponent on, making sure there is clarity around what is a security and what is a commodity. And I think we're going to see the SEC lead that definition and be quite influential with the G20 regulators, but we're ultimately going to see both types. So the CFTC in the States will regulate crypto when it looks like a commodity, and we're going to see the SEC regulate when it looks like a security. And I think it will follow historic market order, market structure. And my expectation is that we're going to see market rules that stem around, issuance and issuance of a security versus what a commodity structure looks like. So we're going to see the CFTC and the SEC step in over the next year, 18 months, and bring traditional regulation and oversight compliance structures to those definitions for crypto. And I think that's a good thing. I think that's what this market needs. And we should not be afraid of regulation. I had the honor of building a commodities futures exchange between 2010 and 2016. And I was trading central limit order book and OTC products in the commodity instrument market. And so I welcome what is there inside MiFID II and what's in there inside the CFTC's rules. We will see blockchain bring innovation, Josh, to those rules. The role of intermediaries, the role of clearing banks, the role of clearing systems into the future will change through what blockchain can do. But I think regulators are welcoming that opportunity to have that discussion with the blockchain industry. But on the top end of that, we shouldn't be afraid of what's coming around regulating crypto. It's the right thing for investors.
Regulation is great on cryptocurrency, but it also is paving the way for CBDCs. You have the Brazilian Development Bank launching blockchain network, describing how central bank digital coin systems can halt bank runs, even if they have negative interest rates charging you for savings. In the U.S. Federal Reserve System, there's a case study titled Retail CBDCs in the U.S. Monetary Policy Implementation, a stylized balance sheet analysis on the possible effects of retail central bank digital currencies on U.S. monetary policy implementation. And then in India, the RBI deputy governor said to the IMF that CBDCs can kill private crypto, which I don't think you can kill private crypto, but you can try to regulate it to a certain extent. Richard, having said all of that, how far off are we on a global central bank digital coin system?
Oh, I referred to earlier my observation. We're involved with a few of them, but we've now got over 100 countries launching and participating in central bank digital currency initiatives. US Treasury, UK Sterling through the Bank of England and the FCA, the EU as a community strategy. My observation, I think at this point, there's a lot of policy work going on still. When we really think about the depth of a central bank product structure, we're really only seeing the top level of these structures be addressed at this point in time. How does a digital cash system work, emulating native currency? And so, when we think about the benchmarks, the indices, the bond fulfill on the bigger picture of what a central bank digital currency. So it's not surprising that every nation is taking its own view at this point, and it's not surprising that we're seeing them inside sandboxes. So really, we're seeing sandbox be the 2022 to 2025 era, but this allows really, central banks, treasury functions, policymakers to really come to terms with how does this technology work and how will the full system ultimately be developed over time. But I think this is a great moment in history. We are seeing the start of a very big journey into digital cash now.
We're seeing a lot of places jump on board trying to become first mover advantages themselves, like Bermuda trying to emerge as a block or as a crypto hub. You have Puerto Rico's Act 60 offering 0% crypto taxes. You have El Salvador and the Central African Republic adopting Bitcoin as legal tender. There's a lot of movement. Where are you seeing, Richard, that blockchain? I want to ask first off, what blockchain dominant domains are and how everyday investors will be able to invest in blockchain technology from the metaverse to NFTs and beyond?
Yeah, so I echo your sentiment. I think we see ourselves equally. You've got part of the Caribbean nations are stepping in. Antigua's being very open towards cryptocurrencies and blockchains. TAAL is a company that is headquartered in Canada and lists on the on the Canadian stock market, CSE. But we've also got a second premise in Zug in Switzerland, and Zug is known as Crypto Valley. There's over 4,000 companies operating in the crypto space in all parts of the industry out of Switzerland. You will have seen equally that the UK government made a big open statement that the UK is becoming open for crypto, open for blockchain, and a lot of sandbox initiatives. Singapore has been there for the last 3 years, Josh. I think we've got a lot of nation states trying to figure out through taxation, through mining operations, through running custody banking, can they carve out a niche and can they be an attractive venue, a location for this next shift in the industry? How do investors get involved? Well, I think we have a number of really strong publicly quoted companies, firstly, so you can invest in companies like TAAL and our equivalents on stock markets, and we're effectively the infrastructure players, we're the guys running these operations 24/7, 365, mining and providing, in our case, certainly that utility service of transaction processing. And I would say, watch us over the next few years and we'll become effectively the clearinghouse of the Bitcoin industry. And as you start to see the utility of Bitcoin really play out as a digital cash system, we have a very important role to play. But yeah, I think investors have been already coming in, and this is why we see so many banks. And to your point about Jamie Dimon, there's a lot of institutional clients, but also retail clients demanding access to these products. And that's why we're seeing the transformation through DeFi, and banks having to step up and put desks together and support providing access for customers. But the duty of care still remains. They need to make sure that they're providing access to the right products, and ultimately not just providing a gateway to some of these products I just don't think will be here in the next year or two.
All right. If investors want to learn a little bit more about TAAL, get some more information, they can find you on the OTC in the US under ticker symbol TAALF. Where else can they find you at, Richard?
Yeah, so you can find us at TAAL.com. And I would also take this opportunity to say we're part of the Bitcoin Association. And so go to bitcoinsv.com and take a look at the ecosystem that we're involved with. Multiple exchanges, multiple gaming applications, IoT businesses. We represent the true utility of what Bitcoin is bringing to the world and Web3 services. So take a look there as well.
All right. I think with that, we're going to have to wrap this one up. So I want to thank my guest, Richard Baker, CEO of TAAL Distributed Information Technologies. Richard, thanks again for being with us at CEO Interviews.
Brilliant to talk to you, Josh. Thank you so much.
Appreciate it. I'm Josh Kincaid. This is Seeking Alpha. Don't forget to like, share, and subscribe. Thanks.